Välkommen till Global Games-podden där vi möter förvaltare och profiler bakom världens mest intressanta investeringar. I dagens avsnitt träffar vi Claus Vorm, fondförvaltare på Nordea som bland annat ansvarar för Nordea Stabila Aktier. Det är en fond som fokuserar på bolag med stabila vinster, starka balansräkningar och attraktiva värderingar. Egenskaper som blir extra viktiga i en tid med höga värderingar och ett fåtal jättar som dominerar börsutvecklingen på världens börser. Men före vi drar igång, bara en påminnelse. Vi tipsar lyssnarna om att anmäla er för vårt kostnadsfria nyhetsbrev. Den finns på www.globalgame.se. Där vi varje vecka delar analyser, fondinsikter och marknadstrender. Men nu Carl, tycker jag att vi kör igång.
Det är hög tid tycker jag.
Det är hög tid. Welcome, Dr. Claus Vorm. Nice to have you here.
Thank you. Nice to be here.
I met your colleague, Robert, plenty of times. But I never met you, so it's really interesting. And Robert, you are the team, so to say?
Yeah, behind this specific product, but it's actually so that we are a part of a bigger group called Multi-Asset, which is a big quant group within Nordea. And the story behind that group is that it was founded in Nordea in 2004, and the founder was Abbvie Hansen and me. Abbvie and I know each other back from the university. We both have a PhD in mathematics and economics, and already back at the university had an idea that it could be fun to do something together. And then in 2004, Abbvie was approached. He had been a couple of years in London, and I was after university a couple of years at McKinsey. And then 2004, when Nordea approached Abbvie to join Nordea, he asked, is this the time where we should join forces and then take over the responsibility for the multi-asset team? And back then, there was mainly these more traditional balanced offerings with equity, fixed income, various risk classes. And we also had to take over those. It's still a big cash cow for Nordea and sold through the advisory network. However, we also requested to be able to move the team a bit more in a quant direction because that was our background. And also that we were allowed to start looking into more advanced investment solutions, so risk premium type of strategies, so we could enhance our investment universe. And so that was actually the starting point. And then after half a year or so, I think we recruited Robert. So he was also there from the beginning. And one of the first risk premium we looked into was this called the low risk anomaly, or this mispricing in the equity market where you, on the low risk segment, can find a better risk return ratio. And that was the starting point, that risk premium research within the low risk anomaly area that started the Stabil equities. And then we were doing a lot of different stuff back then, and we decided Robert and I should focus on that specific product and started this long cooperation behind this product. We'd actually now have more than 20 years of track with the same two people managing the strategy.
Do you think the strategy is stable equities? It's particularly interesting right now in the market. Then you have the American stock market. That's it's amazing. I mean, it's surged about 80% for the last 3 years. It's largely driven by a few extremely big companies if you look at a market cap. Are we seeing a bubble, or what's your view on the condition now in the market?
Yeah, I think first of all, you're right that the market has become very concentrated. So we now see that it's getting close to top 10 names in S&P 500. It's getting close to 40. I think it's getting close to 30 on MSCI World. So this huge concentration is very special. And also the fact that concentration are within names that all has, AI, IT related, very strong growth, very strong momentum. So actually now get a pocket of the market driving the overall index that has a very common theme around it. So that concentration is, I don't recall have seen such a big concentration in a common factor ever. If you take stable equities in that market, then it's of course a product that has a specific characteristic given the focus on stability. So it's a product that typically do very well in a down market, had a lot of protection, and the other hand also lacks somewhat in up markets. So that combination is creating the wording winning by not losing. So that's a bit of the saying behind stable equities. It's the long-term compound return that is strong because you don't have the big drawdowns. So the accumulated return is very strong, but of course you also, in strong market environment, as we have seen in recent years, also see the product being lacking somewhat. So whether it's in and out of favor is a little bit based on the market dynamics. So if you take the full history for the product, then we started there in 2006. Then we went through the financial crisis where we added a lot of protection. And then that created both a live track record where we have shown some downside protection. And on the other hand, it also created an environment after the financial crisis where the market started to look for stability, defensive stocks in general. So that started a bit of a longer period where there was appetite for low-risk stocks in general. You started to see the minimum volatility index were launched. We started to see ETFs coming out with mean vol exposure linked to the index. So we saw as a bit of pioneer within that investment style. And then there was a lot of market demand when we also had a live track record. So we were seeing a bit in a sweet spot and capitalized a lot on that and actually had a lot of momentum on that factor until 2016 or so. Then in 2016, Trump were elected and we started a new environment where it was more focusing on growth. And in general, you have had a pretty strong growth focus since 2016. Then you had the COVID and you also had into 2022 where you had a significant drawdown. But actually you have been in a long period now where it has been very much driven by growth and the momentum have been within that. And therefore we have seen a longer period where we have added good protection in the drawdown we have seen, but we have also seen an appetite for stocks with more growth profile. So you have these long cycles where we maybe had a little bit of tailwind until 16, then we have had a bit of headwind since then, given the focus on growth. And I think what we see now is still that when we see the drawdowns, we have the protection in the product. But what concerns me a bit in the recent environment is now this concentration that we see, because that has created a bit an investor environment where being very difficult for active managers to be overweighted where the momentum is. So all active managers that underperform the index, I think a lot of CIOs in pension funds and in the environment in general are sitting maybe with a board that don't understand why they differ so much to the index. So a lot have moved to the index. And when all the peers are moving to the index, it's also easier to move to the index. So we have this peer group comparison. So we have seen, not only in the Nordic, but I think in Europe in general, that there have been a lot of flow into index investors, which of course even, enhances the performance of these stocks even more, because you cannot leave out the big ones. You need to buy those, otherwise the tracking will be. So there's been this, if you want to have the index as the average market performance, that's simply what you say. If you don't really have a specific stock view, you should buy the index, then you'll get something that is the average market performance. But the difference between the equal weighted index and the market cap weighted index is quite significant. And if you look at the recent years, the market cap weight has been significantly stronger because you have this significant overweight. And if you have 5% in Nvidia, that's a pretty significant position also in an active portfolio. And that's actually now, I think, 5.5 or so in the index. So it's created an environment where, and more have gone to the index, but it's also on some pockets now, the deviation between growth and value has widened a lot since 16. On our portfolio, we also see where we have a combination of stability, but also with a valuation overlay. The dispersion between the valuation of the market and our portfolio is also getting, all-time high. And if you look at the fundamental development for our portfolio, it's actually been quite solid. So the underlying earnings growth and dividend payments for our portfolio, so when we're looking at value creation, so shareholder, it's either the earnings growth, also share buybacks and dividend, has actually been the same for our portfolio as the market since 16. But the performance has been significantly weaker. So that have led to this gaps. So actually, we think there's an interesting entry point. But that not say, whether it's the good timing to buy it instantly or today is, of course, a little bit. If you think this momentum will continue, then you should just stay in the index or stay where the momentum is. But when that changes, and I think there's a huge risk of a reversion in the market, then for sure you get a lot of protection in a product like this. So it is a strategy for the investor that might start to be a bit more concerned about, should it all be in these 10 stocks, and should we just keep buying the index, which is more or less buying that concentrated momentum in big AI, IT-related growth stocks, or should you start to diversify? So we believe it's a good diversifier. And the more conservative you want to be, the higher share you should have into something like stable equities or like.
How do you find these stable equities? What's your definition of a stable equity?
So I think a lot of the academic literature, if you're looking into the low risk anomaly in general, is looking at price volatility. And that has also been working historically to buy the stocks with the lowest price volatility. However, we think, you could put more to the process than just looking at that. Then you have the mean vol index where they're looking at the covariance structure. So how do you find the portfolio with the lowest volatility? So that will add something. We think actually it makes a lot of sense to look not only at the price observation, but also the fundamental observations. So if something is very volatile on the share price, it's typically because either the valuation moves a lot or the underlying fundamentals moves a lot. So we think there are these two elements that can cause volatility or risk to a stock. Is either because the underlying fundamentals are very volatile or the share price, especially if it gets very expensive, we think there's a valuation risk. So it's actually these two elements that we are focusing on. Step one is the fundamental stability. So companies that have historically shown to be fundamentally stable, like having stable earnings growth or stable cash flow generation or stable EBITDA or paying stable dividends. So this fundamental stability is the first step in our process. So we're taking the full universe and then we focus on the stocks with the best historical stability, meaning those with the most stable historical development of the financials. So that's step one, narrow down the process to 350 stocks. And then that is updated quarterly, but a fairly stable pool of companies. And then in the second step, we have the advantage of now sitting with a group of quite stable companies. So now the fundamentals, given that they're very stable, they're typically also more transparent. So it's easier to provide estimates for the coming years. So the estimate is also included in the stability analysis, but typically the volatility around that prediction is not that high. So the earnings forecast is typically fairly solid for these stable companies. And therefore, when they look cheap, they tend to be cheap. And when they look expensive, they tend to be expensive. So it's actually the valuation. I think you should be careful with the value factor because something is cheap for a reason. And then you can buy a value trap. But when you then look at this pool of companies, then valuation seems to be working even better when you have that constraint that the underlying business should be stable. And when it then looks cheap, then valuation works very well. So it's actually a two-step approach. Step one, find fundamentally stable companies. And then Robert and I are on a weekly basis then looking at where do we find the best risk to return ratio. They don't necessarily need to be cheap, but at least fair valuation. So if they get very stressed, we typically sell them or gradually reduce them as the valuation gets getting more and more expensive.
If we look at the portfolio now, Alphabet is when we were looking, the largest holding. How do you consider that stable?
We of course have a process where sometimes it's the diversification is also an element in the portfolio construction. So if you take Alphabet as an example, then Alphabet has a lot of recurring revenue for the advertising business. So they actually have a huge part of their business which has been very stable. They have a lot of recurring revenue around that, which has created a lot of historical stability. At the same time, there's of course also uncertainty on, the regulatory risk on the company. They're investing a lot into AI, and this AI is giving us a little bit of diversification. So it's a stable company that's actually providing a little bit of exposure to that theme that is running at the time, being where we also can find some existing stability within the business. So to buy a new startup that is investing into AI will not be our process. But to buy very established companies that are investing into AI, if that valuation is not too stressed, could be an option. So a couple of years ago, we also bought Meta. Back then, Meta was trading at a PE of 10. And you actually back then saw Meta as a company that had a lot of subscription of WhatsApp and Facebook and generated a lot of revenue on that. And the PE of 10 could easily be justified based on that part of the business. And then you could get an option more or less for free on the side where they invest a huge amount of money. And that was, of course, from a business perspective, and our process could be throwing the money into a big hole on all this Meta universe, which then turned into be the AI investment for Meta. However, as long as you got it for free, then we thought, it makes sense for us to buy that stability, and of course there could be some volatility on that option, but the valuation of that was so cheap, and that has then been a company we have been also hedging a bit of the AI exposure, buying it through that way. And the last one is also Microsoft, which is also a very recurring existing business model. We have reduced on all of them because there's a bit of profit taking as they get more and more expensive. And I think there's a valuation concern around that whole pocket at the time being in the market. Because if you're looking at the Magnificent Seven and the revenue for those has been quite strong. The earnings growth for that group has also been extremely strong. But what we now start to see is that the cash flow start to deteriorate. So the difference between the earnings and the cash flow is getting bigger and bigger. And actually, if you're looking at Nvidia's revenue, 40% or so is coming from other Mag 7 names. So it's Amazon, it's Microsoft, it's Google, it's Meta. They're investing a lot into the chips. So they're buying the chips, which are depreciated over a couple of years. All the revenue is coming in year one. On top, Nvidia is buying companies or investing into companies like OpenAI and others. And a part of that investment is requiring that they buy Nvidia's chips. So there you have the same effect, that you get a lot of revenue in upfront, and then the cost is depreciated. And you get this huge gap between the earnings and the cash flow. And of course, that cash flow is going into investment, and that's the normal accounting procedure. But will these huge AI investment lead to future cash flow? That's the big question mark. So that this uncertainty is growing as this gap between earnings and cash flow is growing. So I think there is a risk around that one should be careful about. And then looking at maybe a fair PE for these IT growth companies should be, I think it's important to focus also on the cash flow and to be aware of their opportunities, but there's also risk. And the more or less transparency there is, the less relevant it becomes for our process. We would like transparency, but of course, I mean, you don't really know what will happen on the AI in all dimensions, but it's for sure something we are focusing on and trying to also limit the pockets where we have these type of exposure, so we don't get too much concentration risk in our portfolio.
Meta was really cheap in, it was the fall of 22, I think, where you can buy it for like $100 or so. Yeah. And you sold a little bit of that now, but I see you have quite a lot in healthcare, and the healthcare sector has been doing really poorly the last 2 years at least.
That's true.
What's your view of that sector?
Yeah, so I think that there are some natural biases within our portfolio given the focus on stability. So if you're looking for very stable companies, we typically end up in the stable sectors or industries. So it's typically we find a lot of consumer stable, we find a lot of healthcare, we find a lot of utilities for the prospect list. And then we also look into the other sectors. So if you take the most stable industrial or most stable material, so if you look into material, it's typically a very cyclical sector. Then Air Liquide is one that is a candidate. Air Liquide is doing industrial gases a lot to the hospital. So you get if you look into the business model, understand why it's more stable than the other materials, and then it's still a bit correlated to that sector. So we get some diversification. So we'd also like to get, but it's unnatural that we get a bias to the most stable sectors. Also contrary, we get a bias to US because a lot of the stable business model is coming out of the US. There's a lot of healthcare, there's a lot of consumer stable, where Europe is a bit more industrial driven. So we like to get European exposure, but there's also a natural bias to the stable sectors and to US for historical reasons. Looking into healthcare, then healthcare was also big in the prospect list when we started the portfolio, but actually not so big in the portfolio because back then it was more expensive. After the financial crisis, they dropped together with the market and became more attractive valuation-wise. And since then, we've actually had a quite significant 20% or more since 2009 or so, I think, in healthcare. What is important for us when we then look at, do we have around maybe 25% today? It's important that we ensure that we are diversified across the value chain. So we typically model, what are the exposure on the producers? That could either be equipment, healthcare equipment, or it could be drugs. What are the allocation to the distributors? And then you have the insurance part. Both the managed care and the PBMs. So we try to map the value chain and then how much of the revenue from the companies we are invested in are falling into these different pockets. And then ensuring that we're not getting too much concentration risk, which then could hurt us when there's, political risk in US, tariffs, pipeline risk. So, both company, but also these value chain related risk that exist on healthcare. We still think there's a lot of attractive risk return ratios, but true, in general, the stable sectors has for sure not been in favor. I think, of course, also natural that they've been a little bit hurt by the rate increases. So I think a lot of them, we actually scaled a lot down on consumer stables as the rate came up, because then I think some of the most stable consumer stable names like Procter & Gamble and Colgate, and they're typically companies that trade a little bit like a bond proxy. So when you have rates coming down, as they did for some years ago, and stayed low, then you start to look for alternatives. So instead of buying a bond, could you find, a bond-like equity that are giving a higher earnings yield than the rate you can get on a bond? And then I think there was a rotation into consumer stable from that. Then when the rates started to increase, you saw actually a bit of the reversal. That led to some interesting opportunities within consumer stable we have been buying into. But on the other hand, I also heard a bit the factor in general. The factor has a little bit higher duration than the market. So I think some of these most stable stocks has also been having a little bit of headwind from the increasing rates we have seen in recent years on the more defensive sectors has been lacking a bit, the growth sectors.
So it should turn around now?
At least I think in that one now, I don't necessarily think that the rates are going...
you see this a little bit in biotech. In the last few months,
yes.
Like Labcorp and some other names, Abbvie and so.
Yeah.
They are going up now a little bit.
No, but and I think so. I think because as our idea has always been, as long as the fundamental development is solid, then we feel comfortable. So also, if you're lacking performance-wise, if the fundamentals, if the earnings are growing, if the cash flows are being generated, if the dividends are being paid, if they buy back their shares. So we like to see good shareholder policy, so good capital discipline, and not just starting to throw money against, a new random AI project, but actually then pay back to the shareholders. If they continue to have a solid, good development, then this weak performance will just lead to better valuation. And that's actually what we have seen. So we have seen for a long time, and we know these cycles can be long, and the recent years has been a bit painful. I think everyone was happy in 22, but 23 and 24 has been a tough market for these type of strategies. Yeah. I also think we are now at a point when we're looking at the fundamental development, the recent years of the portfolio, the names we are holding relative to the market and how they're trading valuation-wise. I think you actually can buy quite solid stocks at a good price, and at the same time buy some insurance if you start to get more uncertain on. But if this rally will continue and the momentum will stay in these big names, I will not sell this product because it should beat that performance then. But I'll buy this to get a solid performance where you also had, some better protection if you'll have, if it turns out to be a bubble. No one knows where. I think it's very difficult with the AI because with the AI you don't really know who will capitalize. So a lot of it's not very proprietary, a lot of the AI. So, all this administrative work you can get rid of by implementing AI. It's not depending on a company-specific model. These large language models, are quite generic, and all companies will do the same. So if all companies will cut the cost equally, then they'll start to sell the product cheaper, and then it will be the customer that will be the winner in the end. So the question is, all these AI investment, who will actually benefit from that? I think that's very unclear. So of course, in our process, we cannot avoid the AI risk because it's coming across all industries, but we can of course just ensure that we continue to have, another big holding is Vinci. That's a company that's, their operation is not very AI driven. You have utility companies, you have consumer stable companies. So companies that of course will partly be affected, but it's not a significant disruption of these type of industries. So it's important that we also continue to have that focus within the portfolio, that we stick to there where we have most transparency and least risk of disruption.
Do you see any similarities with AI today as the internet and telecom bubble by the millennium? Lots of the telecom companies were, they were bidding for licenses, and it got crazy,
Yeah, there's I think there's some similarities for sure. And one of them similarities is probably also that even today it is very difficult to point at something that could have triggered the financial bubble to burst. So you cannot point, if you just have looked at that number, then you know it will happen on that day. And I think it will be the same for this one. I think because when the earnings, you can maybe capture a little bit in the earnings, but when you start to see it in the earnings number, it's often too late relative to the price reaction. So that's of course, so to time it very precise is extremely difficult, and I think it will be the same for this one. So when you start to get more concerned, then you start to, I think it'll be natural from a portfolio construction perspective to start to, if you get gradually concerned, gradually scale down on that specific exposure and not do it on one day, average in and average out, other things within the investment world. If you're not certain on the timing, then if you have 10 million SEK and want to invest, don't invest them all in one day if you get them all up front. Then it's good to take it stepwise. And I think the same for this one. If you start to get concerned about the valuation and the uncertainty, because what I think is very general for the financial market is that when you have high growth expectations for the future, for a specific topic, then the market have always had a tendency to overestimate. So you could say, the estimates are too high relative to the realized numbers. So the earnings estimates are typically, the estimates are too high to realized if you compare growth companies, or you could also say that you pay too much relative to the realized earnings. So I think it's very common when you have such a strong theme, it will not reverse before, it's getting too optimistic or too stressed valuation. And when is that point? That's the tricky part. But then I think it's natural when you start to have a lot. I think there's a sign coming up now. You also, stories about Nvidia start to lease their chip to companies, and these articles start to pop up. And I think that my recommendation would be that it would be natural to start maybe scaling a bit down on the exposure to something. I think in the past we actually had a bit of that barbell strategy. So then stable equity could be a very good barbell to have. If you could buy an ETF on AI growth, have it in one side of the barbell, and then stable could be the other one. The problem today is then in the middle should be the market. And if you could buy the equal weight, let that be. If that were your benchmark, then you could have that strategy to have a bit of the IT growth on one side and a bit of stable on the other. But today, actually, if you buy the index, the middle, you're getting extremely high exposure on one side of the bubble, and therefore it's difficult to get the balance. If you measure it against MSCI World Index, then you actually measure it against something that has a very high exposure to this potential bubble or potential area where all the momentum is. So it's already in the average market, there's a very strong bias, or in the index, which a lot of investors are measured on, having a huge bias to that theme. So it's hard to create a balance on that because it's already a part of the index, also a big part of the index.
You're quite significant exposure to Japan, which is an upcoming market. What kind of exposure do you find in Japan?
Yeah, so Japan is also a region where it's a little bit more tricky to find the names, because typically, they have been also a lot into tech. We like the diversification from Asia in general. So we've also had some Australian names. And Japan has been mainly telcos. We had a little bit of pharma, but there have been actually a couple of telco candidates. In the past, we also had better railways, but they they started to invest too heavily, and the capex was, or the debt level was growing too high. Today it's mainly healthcare and telco.
And telco. But Warren Buffett likes Japan.
Yeah,
he has been doing lots of investment for the last years in the what you're calling trading houses or conglomerates or that kind of big names. Do you see any value in that? Or
often, we typically have the process that the idea with the prospect list is that they need to meet these criteria to have, because that's a part of the factor that we are selling to our clients. So we cannot buy. We need. A part of the objective is to have downside protection. So we, of course, cannot just run after every theme we think is interesting. So there could be a lot of good companies for a lot of good reasons. But if we don't expect them to be adding protection in a drawdown or having a low capture ratio in drawdown, then they don't really fit in. So diversification story is not enough. So if you take an MSCI minimal volatility, they also have gold in their portfolio. And you typically see gold performing well, but we don't have the fundamental stability in a gold company. So what is really the cash flow that you're getting if you're buying a stock with exposure to gold? So that sense we require that, and therefore also the idea with the prospect is that we get in names that we get more and more familiar with over the time. And then there could be a lot of other interesting theme, but if they don't make it to the prospect list, then we don't spend time on that, because we have a part of the objective to have this stability. So there could be interesting investment ideas that we could look for in other parts of multi-asset, but not for this specific product. There are some upfront requirements that need to be met.
Claus, quite obvious. You think for someone to invest in Nordea Stabila Aktier it's kind of protection if the environment get more volatile, or if it's an AI-bubbla?
I think it's a strategy that now for a couple of years actually have done quite well fundamentally. So actually, if you're looking at the underlying fundamentals in terms of earnings growth and dividends have been paid on the stocks that we are holding, I think there's been very strong fundamental performance and also good capital discipline in the companies that we're holding. And these stocks have not really been in favor for the market. And that's actually, if you're looking at a graph since 2016, that spread between, the valuation gap between the market and our portfolio has just widened gradually and is now at an all-time high. So I think it's a good entry point for these type of stocks. Start to buy some of those because I think they look attractive from a strategic valuation point of view. Timing-wise, then I don't have a strong view on whether this momentum will continue. It could easily do. It's not that I have a strong view that it's stopping now, but I have a strong view that there is a good valuation of the companies that we hold in this portfolio. And the characteristic of this portfolio will help to protect if there is a bubble or if the market will flip around. So I think for investors that I think I'd like to take a bit profit on all this growth that have been in recent years, then maybe scale a little bit down on the index exposure or exposure to names with these characteristics. I think stable equities is a good value proposition for that. Of course, there will be a tracking error to the index, given the index has this construction that we see. So one should be aware of that, but we are looking much more at absolute risk than the relative risk. And I think that's also part of what's creating the mispricing of these stocks, is that the market have this huge focus on relative risk more than the absolute risk. So you can actually get a low absolute risk with a good valuation because the market is focusing much more on relative risk than absolute risk in the current market.
Yeah, thank you very much for your participation.
You're welcome.
Tack så mycket för att ni har lyssnat.
Tack så mycket.
Vi vill påminna om att allt som diskuteras i denna podcast är gästernas och våra egna åsikter. Ingen del av samtalet ska betraktas som investeringsråd. Gör alltid din egen analys eller rådgör med en kvalificerad finansiell rådgivare innan du tar investeringsbeslut.